Prior to the pandemic, wages were growing consistently faster than inflation, the red line, and that gap reflected labor productivity gains. Following the pandemic downturn, wage growth initially lagged price growth, and of course, that had implications for purchasing power for households, despite the fact that productivity continued to improve. Therefore, there's room for wages to continue increasing somewhat faster than the Fed's 2% inflation target plus trend productivity growth without necessarily being inflationary, but to make up for some of the previous productivity gains and price increases. And that's one of the many things that we're watching carefully. And I think there's some good news there for workers as well. I remain, as I said, a realistic optimist in thinking that the economy is on a path back to 2% inflation on a sustained basis with a healthy labor market. The economy is in a good place overall and policies well positioned as policymakers carefully assess the evolving data and outlook. I do want to see more evidence of that sustained trajectory. And consistent with projections from FOMC participants, I do believe it'll be appropriate to begin easing policy later this year. And when that happens, a methodical, forward-looking approach to gradually reducing rates should provide the necessary flexibility